You've probably seen them, right? Those absolutely gigantic, windowless buildings that seem to be popping up everywhere along the highways. Well, they might not look like much, but they are the epicenter of a massive, and I mean massive, hidden boom in real estate. So we're going to dive into this because there are some really powerful economic forces reshaping our world right now. And believe it or not, it all comes down to the simple warehouse. Yeah, this quote, it absolutely nails it. A huge fundamental shift in how the entire global economy works is happening as we speak. For decades, one system was king, but that system is now breaking down. And that's creating a colossal disruption. But for a few investors who saw this coming, it's creating an unbelievable opportunity. All right, so to really get what's driving this boom, we first have to understand what exactly broke in the old system. And we're not talking about a small crack here. This is like a foundational shift in the very logic that's powered global trade for a whole generation. For the longest time, the whole world ran on this one big idea: just-in-time delivery. It was all about being incredibly efficient. The goal was to have parts show up at the factory just in time to be put into a product, and for that product to show up at the store just in time for you to buy it. It meant companies kept almost no extra inventory to cut costs, and it all depended on these super long, super complex, but supposedly flawless global supply chains. And this slide just lays out the shift perfectly. On the left, that's the old way. These long, fragile supply lines stretching all the way across the planet, totally vulnerable to any little disruption. But on the right, that's the new way, building in a safety net, a resilient local supply chain. We're moving from just in time to something more like just in case, basically holding more stuff closer to home just in case something goes wrong. This is the whole nearshoring revolution in a nutshell. So, as you can imagine, this shift has kicked off an absolute scramble. It's almost like a modern-day gold rush, with companies all racing to adapt to this new world. They are literally rewiring the physical pathways of global trade. And that, of course, requires a completely new infrastructure. And just to give you a sense of how huge this reversal is, look at this number, 120%. Since about 1990, when China and Eastern Europe really joined the global economy, it was like adding a workforce that much bigger to what the developed world already had. That right there is what fueled decades of outsourcing. But now companies are rethinking that entire playbook, and suddenly they need new places to store all their materials and products. They need warehouses, and not just a few, they need lots of them, and they need them closer to home. Okay, so we get why demand is off the charts. But how does that actually turn into people getting rich? Let's pop the hood and look at the investor's playbook, the actual mechanics of how these buildings are valued and how savvy investors are cashing in. This is the key. You have to understand that a commercial property, like a warehouse, is not valued like your house. The value of your house is based on what other houses in the neighborhood are selling for. A warehouse's value? It's based on one thing and one thing only. It's net operating income, or NOI. Just think of it like any other business. Its value comes from the cash it generates after you pay all the bills. Now, this leads to a really powerful strategy that investors use called forced appreciation. Here's how it works. An investor finds an underperforming warehouse, one with low rents or high energy bills. Then they get to work. They find ways to increase the income and cut down the expenses. That directly increases the NOI. And here's the magic trick. Because the building's value is tied directly to that NOI, they have literally forced the value of their own asset to go up, no matter what the rest of the market is doing. Okay, so everything sounds pretty great, right? Demand is through the roof, investors are making a killing. But, and this is a big but, every boom has its risks. As all this money has flooded into warehouses, some familiar and, frankly, some worrying signs are starting to pop up. You have to ask, is it possible this whole thing is overheating? I mean, on the surface, things look incredible. Demand is sky high. In the US, vacancy rates are expected to stay around a very healthy 6%. And if you look at the key nearshoring hotspots, the numbers are even crazier. In places like Monterrey, Mexico, vacancy rates have basically dropped to zero. Industrial areas in Poland are seeing the same thing as companies move production there for the European market. By all the standard measures, the market looks rock solid. But underneath that shiny surface, there's a dangerous word that developers and investors have started whispering to each other: hyper supply. And this is the classic trap of any real estate boom, when all the excitement and high demand leads developers to just build too much, way too fast. And the danger of hyper supply is just simple economics. When you have way too many warehouses and not enough tenants to fill them, the power shifts. Tenants suddenly have all the choices, and to compete, landlords have no choice but to start lowering rents. And what does that do? It directly attacks a property's net operating income, which, as we just learned, is the very thing that determines its value. And you know what? We have seen this exact movie play out before. Just look at Japan in the 1980s. You had this massive real estate boom, all fueled by easy, cheap credit. Prices went to the moon. But then, the adjustable rate loans that paid for the whole party started coming due at higher rates. Owners couldn't make the new payments, so they were forced to sell. And just like that, a market that seemed to have endless demand was flooded with supply, and the whole thing came crashing down. And that brings us to what might be the single biggest threat hanging over this entire boom. It's not just about building too many warehouses, it's about how all those warehouses were paid for in the first place. $1.8 trillion. Just let that number sink in for a second. That is the amount of commercial real estate debt that is set to mature in the very near future. It's an absolutely staggering number, and it represents a ticking time bomb for the entire industry. This is what the experts are calling the wall of maturity. A huge chunk of this debt is from loans that were made between 2019 and 2021, back when interest rates were basically zero. Now, those loans are coming due. Think about it like this. It's like having your home mortgage at 2.5% and suddenly being told you have to refinance it at 7%. Now, just imagine that, but on the scale of $1 billion real estate portfolio. The difference in payments creates a massive financial black hole that many owners just might not be able to cross. So here's the bottom line. The huge demand for warehouses, the whole nearshoring trend, that is absolutely real. It's happening. But the boom itself has been financed with a mountain of cheap debt. And that leaves us with the one question that should be on everyone's mind. What happens when that bill finally comes due?